Please welcome the well-known Burton from London. He's with Piran Mining Research, and as said, he will give us a speech from nuggets to necklace, and he want to talk about gold supply and demand explained. So, welcome. Paul, thank you.
Thank you, Joachim. I hope everybody's not too sleepy after all that food. It was delicious. You'll be pleased to know that I'm not a geologist. I am but a simple mining engineer and mining analyst, I suppose. And that's one reason I'm going to talk to you tonight about the gold industry and the gold supply of metal, where it goes, where it comes from. The title is called From Nugget to Necklace. You can see a lovely example of some Indian jewellery there. Well, up there, I'm reading it from the back. Now, as I said, I'm not a geologist, I'm a mining engineer. I'm also not a commodity analyst, so I don't look at the big figures, the big picture for gold supply and demand. There's a number of groups out there, Metal Focus, GFMS, the World Gold Council. They put these figures together. They look at supply and demand of gold every year and every quarter and come up with some balance for the market. Now, I don't necessarily believe that's the correct way to do that. I think that loses a lot. We can only explain half the market that way, and I'll show you a bit later why I think that. So I'm going to take you through some trends rather than looking at a fixed picture. Right, that's me, as I said, not mining engineer, not geologist. That's a mine, because I'm a mining engineer, and I always like to have a picture of a mine in my presentations. No other reason whatsoever. Right, to start off, let's have a look at the gold price. You're all probably familiar with this. This is in US dollars an ounce. It's the annual averages, so it's not as steep as you might have thought when we saw, if you look at the spot price on a daily basis. But you can see the peak up to 2011, and actually the average price was higher in 2012, and that's why it peaks there. So you can see this bull run we've had since 2001, and then coming off in the last few years, and then a tick up this year. So that's a good place to start to put everything into perspective. Now, to sort of have a common term or common reference point here, I thought I'd look at a snapshot of supply and demand, having said that I don't necessarily believe that's the best way to analyze our market, but I think it works just as a reference point, so you can see where supply comes from and then where it's going. And then I'll talk you through the trends of those, because I think that shows a better picture. And then I'll discuss why that is not the full picture and the other things you have to take into consideration when you see the gold price moving as we did. So, and I'm going to use ounces. We heard when the guys were up here talking about resources, they talk in ounces. They might talk grams per ton, then switch it to imperial, and we always use ounces in the ground. A lot of the analysts, the commodity analysts, will use tons, but I can't imagine what a ton of gold looks like. I know you people in Zurich probably are familiar with that, but I prefer to just look at an ounce of gold. So all my figures are going to be in ounces. So total supply in 2015 was 139.8 million ounces. Total physical demand was 140.1. So it looks like there's a deficit there. Now, I haven't included what are known as ETFs in that, and there's some gold demand there. I'll come on to that, explain that a bit later. But it looks like there's a deficit there, but it doesn't really explain half the market. So let's look at where the gold came from on the supply side. Gold mine production makes up about 3/4 of supply in the market. That's what you would expect. It's gold from primary mines, byproduct of silver mines, and byproduct of base metal mines. And then recycled gold, scrap gold. It doesn't seem right to call gold scrap at any stage, but gold that's been maybe at a higher price come back into the market, been melted down, and then been probably made into another set of jewellery. That accounts for about 1/4 of the market. And there's a very small sliver there, which is gold mine hedging. And I'm not going to discuss that tonight because it's really not in the big picture of gold at the moment. A few years ago, it was it was a big thing with the gold miners selling their gold forward and bringing a lot of gold into the market at an early stage before they'd actually mined it. And that was one of the big factors for the gold price going down in the 1990s, and also led to a couple of companies going out of business. But it's not a factor in our market, so I won't discuss that. But I'm going to look now at the trends in the supply. So let's look at gold mine production. Sorry, no, let's not look at gold mine production. Let's look at demand. Jewellery, of course, you probably expect that. Jewellery makes up the biggest sector of the market. 56% of gold goes into jewellery fabrication. And then bars and coins, that's the Kruger rounds and the 10 ounce or 100 gram bars that you can buy, make up the second biggest part of demand. That's 23%. The central banks, they are actually buying and have been for a few years. So they're quite a big factor at 13% of the demand side. And then industrial demand makes up the smallest bit at about 8%. So now let's look at mine supply. There's a typical mining headgear in Quebec. So let's have a look at the trend in gold mine supply. So there you can see from 2006, we've seen quite a steep increase in gold production, right up to 2015. Now, why is this? Well, here's the economic crisis of 2008. And after that, the gold price dipped. We started to see the gold price going up again. But before that, there was a couple of things that happened. That gold price rising from 2001 up to that period basically made a lot of projects that were known, existing projects, made them viable all of a sudden. At higher prices, you could run the numbers and you could actually figure you get a mine there. And importantly, you could actually finance it. The banks were willing to loan and the equity markets were up for funding these things. So in those times, we saw a lot of those projects coming through and they've swelled the supply of gold in the last few years. That increase is not due to any new gold being found. Two reasons. Firstly, the geologists haven't found much gold. Secondly, even if they had found any, there's such a lag time involved in finding gold and then actually getting to the production stage that anything that was found when they were spending a lot of money back here, because exploration spending was at a peak back here. They were spending billions, but the records show they actually didn't find much. So this is stuff that was started back here from known deposits and has come to impact on the supply side in the last few years. So much so that in 2015, gold production actually reached a record of 103 million ounces. It's climbed to that peak, and it is a peak, I think. It's record gold, and I think it's probably going to be peak gold. Gold production is already down 2% this year, and we're likely to see this trend because the geologists can't find any gold. Now, these are the biggest producers in the world, the top 5 producers. And China has grown dramatically and is by far the largest producer of gold in the world at the moment. In second place, you have Australia. I heard a yay. Okay. Third place, we have Russia. No Russians. Okay. In fourth place, we have the US. And then Brian would be pleased to know that in fifth place, we have Peru, who always known as the largest silver producer in the world, but now a very important gold producer as well. Now, China's growth has been absolutely phenomenal. So let's have a look and see how they've grown. So from 2006 up to 2015, 15, their production's actually doubled. And why is that? Well, there's been investment from foreign companies, mainly Canadian and Australian. A lot of those have retreated now. There's been an increase in domestic gold production. But importantly, there's been, driven by their need for base metals, the smelters in China have been working at full capacity, and a lot of the gold comes out as byproduct of the copper and lead zinc smelters. So, and that's added to their inventory a producer of gold. So that's the main reason China has grown so much. So that's the production scene at the moment. Let's look at the second aspect, which is recycling. Now, this is a fascinating picture because recycling is so price sensitive. So you can see here in end of 2008, and certainly in 2009, after the economic crisis, there was a lot of distress selling. People needed cash, so they just sold. It was you probably remember. Probably didn't do it here, but certainly in UK and in US, you had cash for gold envelopes coming through your door, and people piled in, selling old jewelry just to get cash to pay for some of their other losing investments. And recycling is very, very price sensitive. So when the price is high, and not just the US dollar price, you've got to look regionally, you've got to look at some of the other currencies and see where their price is high, then you can expect to see this gold coming into the market. So for a few years, we saw recycling, scrap gold coming back into the market as a very big element of the supply side. It's tapered off in the last couple of years, 3 years, with the gold price coming down again. So it's very price elastic. I'm not going to talk about hedging, as I said, because it doesn't really factor in at the moment. So those are the trends we've seen in the supply side. Now, what about the trends in the demand side? Jewelry. And that's a wonderful example of an Indian necklace. Now, jewelry, again, is pretty price sensitive, but there's also a number of other factors at play. So if you look here again, look, there was the economic crisis in 2008. 2009, jewelry buying just almost disappeared. It was on the trend. It was very much lower, but it started building up over the next few years as people got more confidence and thought that the gold price is recovering and it's going to go higher. And then there was this phenomenal event in 2013 when China just started buying jewelry. China just came out of nowhere and started buying jewelry, and that pushed jewelry buying up to the record level. It's come off a bit since, and that market's not looking so healthy as we speak today, but I'll come to that at the end. And this slide shows you all know about India. I've talked about India as being one of the biggest fabricators of jewelry and users of consumers of gold jewelry. And you can see in the blue lines, that's Indian gold consumption in jewelry, and that's been fairly steady. But here's the Chinese coming out, and you can see there was the 2013 that I mentioned. Huge impact, and between them, the two of them now account for half the world jewelry consumption. So those are the two main players in jewelry demand. This is industrial demand. I won't spend too long on this because it's not a major factor in the industry, and it's been fairly constant over the last few years. This is gold that's used principally for electronics, in mobile phones, computers, and lesser amounts in dentistry and for decorative purposes. It's about 7% of the market, 7 or 8% of the market, and it's been relatively stable over the last few years. Bars and coins, there you can see a typical 100-gram bar and typical coins. Now let's look at the trend here. And you can see there was huge growth post-2008 again, right up to 2013. Again, very huge volatility in these figures on an annual basis. And in 2013, we saw earlier that China bought a lot of gold jewelry. It bought a lot of gold bars and coins, the Chinese, in that year. There was growth in the US, in Europe, in India, but it was Turkey and China that particularly weighed in and bought a lot of gold in form of bars and coins that year, and swelling that component of demand up to record levels. It's come off again in the last couple of years with lower prices and movement away from bars and coins in particularly in the East. Central banks, right. Now, central banks, you may know that a few years ago, they were big sellers of gold. In the 1990s, 1999, they formed this accord. The European banks were going to sell 400 tons a year, and they did for many, many years. But that situation's actually turned around, and now the central banks are a big player, or some of them are, a big player on the demand side. So here's the trend, and you can see up to 2009, they were on the other side of the equation. They were actually selling into the market and helping depress the gold price. But as the gold price, started going up and peaked, the central bankers typically, counterintuitively, started buying more, like they sell at the bottom, like the UK did in 2002, whenever it was, 2001. But they've started buying in the last few years, and you can see how dramatically that picture has turned around from being net sellers to being net buyers. They're not all buying, as I said, it's mainly Russia, China, and Kazakhstan have been buying, and Venezuela is actually selling, on countering that. Venezuela is actually selling because it's got so many dire economic problems. So the central banks has been a big swing factor in the gold market in the last few years, helping the gold price get up to $1,900 and actually helping it stabilize, relatively speaking, above 1,200. Now, this is, I love a bit of a digression, but just to let you know who holds all this, all these central banks, who holds them, the gold, and how much they are. So the United States is the biggest holder of gold, 261 million ounces. Germany, the IMF, Italy, France, big holders of gold. Switzerland there, well, you sold some a few years ago, unfortunately. But still 33 million ounces. So a lot of, and the Netherlands there. So there's a lot of European banks still owning gold. But what I think is even more interesting, if you look at the figures here, is what that percentage of gold makes up of their reserve, their total reserves that they hold. And it's all pretty high, above 60, 65% in the European countries. But look at China. Where is it? 2%. And that's one of the key metrics that the gold bulls will point to say, that's the future, because China will start buying to take its percentage of reserves up to 7% with Switzerland, or maybe up to 10% with the UK. But certainly we wouldn't dream of going up to those sort of levels. But that is one of the most bullish factors out there, that if we do see the Chinese start to rebalance their reserve to have a lot more gold in, more equitable with what the rest of the world is doing. So that's a really fascinating slide, I think, as a mining engineer. And now, up front I said you can't analyze gold by just looking. If you look at copper, you can look at supply, demand, and if there's a deficit, you say, well, the copper price is going to go up. If it's a surplus, well, and next year, well, the copper price is going to go down. You can't do that with gold for three main reasons, I believe. Gold is, as this audience well knows, gold is a currency and an investment asset, and is also prized by some cultures for adornment. So the price is affected by many other factors outside of fundamental physical demand. Secondly, the above-ground stocks of gold actually dwarf mine output. You can't say that for copper. Basically, what's mined each year gets consumed pretty quickly, and a few stockpiles around. But above-ground gold stocks dwarf the mine production. And probably the key thing is much trading in gold is actually in paper gold, with no physical metal ever changing hands. Now I'm going to explain explain all of these in a little bit more detail now. So firstly, gold attraction for investment and adornment. Now my friend Frank Holmes, who runs the US Global Fund in the States, loves to use these terms, the love trade. Well, he actually says the love trade and the fear trade. And that's because the love trade refers it to those who buy gold because they have affinity for the yellow metal. And gold and demand is driven there by the culture, tradition, the wedding season, and religious festivals. And let's be clear, the love trade drives most physical demand. You saw it, 50% of the industry is gold goes into jewelry. The fear trade is about being afraid of losing your wealth, being afraid of the uncertainty, the risk involved in holding bonds, stocks, currencies. So fear trade is all about protecting your wealth. And demand is driven by a whole multitude of things, such as real interest rates, monetary policy, US dollar strength, and economic growth. So the love trade, we all know about India. I've mentioned India before, has a great affinity for the metal. And Diwali, the Festival of Lights, started 2 days ago, goes on all week. And it's always a great time for giving gold in the country. And a lot of this gold is actually bought, by a third of it is actually bought in the rural population, by the farmers. And if they've had a good monsoon, they've had a good monsoon this year after 2 years of drought. So they've earned money, they've got better income, they're wealthier, and they will be buying gold. India's a funny country. I was talking to Jay earlier on about India and some of the dynamics there. They've taxed imports, now they're lowering the taxes. The government sort of tries to stop gold coming in, but having said that, the government's now launched an Indian coin, an Indian branded coinage, you can see there. And then you remember the charts I showed you of Chinese demand. That has been growing amazingly in the last few years, and they're becoming increasingly important as jewellery buyers. And we hope to see jewellery buying going through to the Chinese New Year in January. On the fear trade, as I said, it's all about investing in an asset class which can protect you against volatility in stock markets and currencies, and can also ensure returns and growth when cash and bonds have negative real interest rates. Here's a chart from US Global, from Frank Holmes' team again, which points this out really clearly to me. If you look at the blue line, that is the yield on a 5-year Treasury bond, and you can see that earlier this year it went into negative territory. So inflation minus the nominal rate ended up in a negative return. You're paying the bank for them to hold your money. And what happened? There was an inverse correlation with the gold price. The gold price immediately started going the other way. That's a very important inverse correlation there, but it explains a lot about what we saw in the gold price movement right throughout this year. What I've done here is put the love and fear trades together so you can see those trends. The love trade is jewelry. The fear trade is central bank buying, or central banks buying or selling coins and bars. And then I've added in ETFs, which I haven't discussed yet, I know, but I'll come to that in a minute. And you can see with central banks being negative, being sellers here, the green lines of the fear trade are actually quite small, but it increases importance as we go through the economic crisis. And in the last few years, we've seen a much bigger share of the market being driven by the fear trade. And ETFs were negative in these years, so that's the net figure. So the fear trade has become a very, very important part of our market. Secondly, so this is the second point about why I don't think you can just do a standard commodity analysis when gold's involved. Because of its unique properties, it's a noble metal, it's corrosion resistant and unreactive. Virtually every ounce of gold that was ever mined is sitting on the surface or sitting in a bank vault somewhere on the planet. Now, the estimate of stocks of gold, just for interest's sake, are 6,000 million ounces, 6 billion ounces of gold, as at the end of 2015 are thought to be out there. Annual gold production, remember this figure from early on, is only 103 million ounces. So no other metals have an inventory like that dwarfs the annual production. No other metals have 58 years of current production sitting around somewhere waiting, theoretically, to come back into the market on the supply side. Where are those stocks held? And we can try and... I said theoretically they can come back in. We're not sure. Sometimes they're stickier than others. They'll never come back into the market. They'll never upset the balance. But other times they could just come back into the market with just a press of a button. 47% is held in jewellery. Some of that, as we saw with the recycling, can come back into the market at any time if gold prices are high enough. Then there's private investment. That's mainly bars and coins. Again, some of that can come back into the market. The official sector, 16%. Now, we've seen that the central banks have sold in the past, so we know that the likes of the States and Germany and France and Italy aren't going to sell, but there's other central banks who will sell. So some of that 16% can come back in. Now, the The other 15% is, and I've been trying to find out what that is from the analysts, but it's other fabricated. So nobody quite knows what it is. It could be the gold in your phones. That could come back into the market. It just could be anything. In fact, if you're lucky enough to get invited to Patrick Michael's house, you can see where some of the gold goes. And then when you want to lift home, just go and speak to Joachim here, and he'll take you home in his car. Okay, paper gold. This is one of the most important things in our market. Gold is traded through the futures exchange and what they call over-the-counter, OTC. Now, the biggest futures market in the world is COMEX in the US. It generally has a very high entry level. The minimum contract is 100 ounces. And thus it's used by institutional players in the market and high net worth investors. They have launched a smaller one called the ETH Micro, but predominantly things are in very large bundles. So the contracts are almost exclusively settled before delivery. They're selling on a forward date, and when they deliver, a lot of the manufacturers using gold might use these to hedge their price risk. But no gold actually changes hands. As soon as they've actually got their gold and sold their gold, then they close the contract out. But participants can go long and short for a start. They can sell gold on that market, paper gold, and they only have to put up a cash margin. So they don't have to pay for it all. They just have to make sure it's marked to market every day, but they put up a cash margin of about 10%. So it's easy to get leverage. You can buy 100% just by putting 10% down. And so it's open to speculation. And one of the biggest areas of the COMEX is the speculators. They drive a lot of that market. And they drive our market. They drive the gold price. Some of the figures are staggering. So what the volume traded in paper contracts, not an ounce of gold changed hands, the volume traded in 8 months to the end of August was almost 4 billion ounces. You remember the figure for stocks was 6 billion ounces. So in 8 months, COMEX turned over 2/3 of all the gold that was ever been mined. 2/3 of the gold that we know exists was turned over in paper in those 8 months. And then we saw record long positions of 44 million ounces in July, and they moved up from 1.5 million ounces at the beginning of the year. And that was one of the other things that drove the gold price up, with people taking bets on the gold price that it was going to go higher. So the long positions of people buying paper gold in the hope that it's going to go up. And that's what it did. So that was one of the big drivers of the gold price in the first half of this year. If you turn to just to show you also how it drove gold price up, but it can so quickly drive the gold price down. This happened in August, just before 8 a.m. in COMEX. Somebody dumped $1.5 billion of contracts, and the gold price shot down 15 to 18% in a matter of minutes. That's how influential paper gold is in our market. So it doesn't matter so much. You need to consider, but it doesn't matter so much about how much went into jewellery, how much is coming from recycling, how much mine produced, how much is going to electronics. When somebody can do that on a paper exchange so quickly, that is one of the things you've got to be afraid of in our market. And that's one of the reasons we see gold price moving and nobody can really explain what's going on till a bit later. They all try and come out with reasons, but nobody quite knows. It's something like that happening. The OTC, over-the-counter table, it's cheaper, it's more flexible, and a lot of people use it because it's more opaque than COMEX, but it is riskier because you have what's called a counterparty risk. Now, that is all changing. The London bullion market is the biggest market in the world, but that is all changing, or is set to change, because the LME Precious is setting up another system of trading gold in London, and gold will be cleared. It will be more transparent, and it will be in direct competition to the current London bull market. The standard size bullion bar there is 400 ounces. If you go to the east, it's 100 grams, so it's a lot different size bar. But again, the trading volumes are phenomenal. And again, the gold won't change hands. A contract will change hands, but the gold will still say in HSBC's vault or Morgan's vault. The LBMA trades roughly 20 million ounces a day. That means all the annual production of gold mines gets traded in London in a week. So if you look at what COMEX can do, you look at what the OTC market in London can do, and it's absolutely phenomenal that they play such a role in our market and can determine the price so easily. ETFs, now I've talked about them, I've alluded to them, and I'm sure a lot of you know about them, but it's an exchange-traded fund and it's a proxy for physical gold. They were first launched in 2004 by the World Gold Council, and they launched them to try and make gold investing more accessible for everybody, and it worked. It was an absolute success. One of the main reasons we saw the gold price rise from 2001 up to 2011, because people could get hold of gold in this form. It's like an equity. It trades on a stock exchange. The biggest, and each share is a tenth of an ounce, I should say. The biggest is the SPDR in New York, which trades on the stock exchange as GLD. And it's had a phenomenal impact on our market. If you look at the trend here, you can see that it was very definitely on the positive side of the market when it was launched back here in 2004, and then increasing all the time. And then in 2013, we saw a huge sell-off. A huge sell-off of gold or ETFs that are all underpinned, somebody will probably sniggle at that, are all underpinned by gold. They actually do have an allocation of gold. Some people think that it probably doesn't exist, and, well, we don't know. But a lot of that gold should be in HSBC's vaults in London. But there was a huge sell-off. Now, 2013, remember what we saw earlier with 2013? That was when China was buying its jewellery. That's when China was buying the bars and coins. There was a phenomenal shift of gold coming from the West, and the ETFs are mainly European and US-based. So there was a huge shift of physical gold coming from the States and from London, coming through here, coming through Switzerland, being remelted into bars that were more, that the Chinese in particular and the Far Easterns like. Instead of 400-ounce bars, there were 100-gram bars. So, and a lot of that was coming through here, coming to Switzerland, into the refineries, and then going on east. It was a very discernible east-west, west-east trend in those days, just 3 years ago. So there's massive selling from the West in 2013. A lot of people thinking that was it for the gold. Gold has it's had its day, and we'll no longer have faith in it. This is a full picture of the ETFs. These are the cumulative figures, and you can see how close the growth in ETFs matches the gold price. You can see it's almost 100% correlation. So that was a key influence on our gold price in the bull market. And again, as I said, it was mainly North American and European buyers. And they stand currently at about 75 million ounces. So where are we now? Let's look at 2016, just to wrap up. Well, some stats. Gold price rose 29% this year in US dollars to July, and is still up 20% year to date. It was the best half-one performance in the gold price since 1974. So it was a phenomenal rise in those first few months in particular. But the fear trade is ruling at the moment. It's all about investment, it's all about ETFs, and it's not so much about jewelry at the moment. Let's have a look at the gold price. You can see there that phenomenal rise in the first few months. Then we sort of had some sideways trading, started down a bit in the typical summer doldrums, but then there we are. That's why I'm an impoverished Brit. That was Brexit. Gave a great stimulus to the gold price. And then we've seen it trading rather sideways up until the beginning of October, when we saw a bit of a sell-off again. And that was to the end of last week. We've seen it notch up a few points again this week. So the love trade, it was a very poor first half for jewelry. And Q2 was down 27% year on year from last year. It was a 7-year quarterly low and Chinese consumption was down 31%. So it's really out of favor. Jewelry is really out of favor at the moment. Asian demand generally was exceptionally weak for jewelry. On the fear side, bars and coins were down modestly at 3%. However, Chinese demand for bars and coins was actually up, so it did counter some of the negative and weak jewelry performance. But the big story of this year is the very strong ETF demand. It's up 44%. Now, if you remember that slide I showed just a few back with the ETFs in the last 3 years being sold off and massively sold off in 2013, we've seen a reversal of that trend. If you look at this chart, which again is from US Global, and what they've done there is put in yellow bars, they've got bar and coin demand, and then they've added the ETF volumes there as well. And you can see that the actual, I'll point up here, though the actual volume in this year actually exceeded all other levels in past years, especially after, there was the big ETF sell-off in 2013, but the first half of this year, that blue bar was now on the positive side, and coupled with the still fairly strong bar and coin demand, it was the best first half ever for investment demand in gold. Here's the ETFs month by month, or cumulative month by month, and you can see this phenomenal growth. This is the 44% growth we've seen this year, and that's up to the end of September. So it's modified and moderated a little bit, but no, there's been great growth in ETFs this year, and that's why we saw the gold price go up this year. Right, some concluding comments. The supply side, mine production has probably peaked this year. It's down last year. It's down 2% already. We don't see many new projects coming through. Recycling price is very price sensitive, so that can come back into the market at any time. And as you saw, there's huge stocks of gold out there, so it's always better to be cautious about what's going to happen. There's little gold hedging at the moment, and long remain that way. On the demand side, love trade is subdued, but we've got Diwali at the moment and the wedding season following that, so hopefully that offers some potential to boost that. The fear trade is the ruling dynamic. There's so much economic uncertainty with US elections coming up, US debt levels, low inflation, but increasing inflation, the dollar strength, and central banks' monetary policy. ETFs and paper gold are very influential on the price direction, and I hope I've brought that message across tonight. And I'll leave you with this. The gold price shot down at the beginning of October and went through the $1,300 mark, as you may remember. And that day, the World Gold Council came out and said, the move seems to be driven by speculation of a scaling back in the ECB's asset purchase program, combined with rising expectations of a US rate hike in December. That's what they always say. The move was exacerbated by technical levels, tactical positioning in derivatives markets, and a national holiday in China. So they haven't a bloody clue, to be honest. But they just drop these things out every now and then to say, yeah, it's probably that, but they don't really know. But if you look at some of the big, that's why I like to look at the trends. The big trends we've seen this year are the ETFs and jewelry going the other way. Investment demand has still been pretty good this year, and that will increase the rest of this year, I think, with all the political and economic uncertainty that still rules the world. And with that, I thank you very much.
So a few decades ago, as you know, it was basically South Africa supplying the world with gold. Today, you showed the biggest producers. It's China. It's a net importer. And it's, of course, Russia. They don't export gold. And so when we look at the central bank buying of those two nations, whereas in Russia you can see every month they added some ounces, and China, of course, is not that transparent. You have some huge jumps, and it's also because it's just the gold holding of the People's Bank of China. But of course, a sovereign fund and the treasury buys domestic gold. So they're playing games with the West. They don't unveil the whole official Chinese gold holding. What do you think about this?
Oh, sorry, I thought you'd answered your own question.
What do you think about this tactical approach of the Chinese?
Well, it doesn't help our job, does it? Sorry, I'll be a bit flippant, but the Chinese are the Chinese. We don't. You're right. We don't know what's going on there exactly. We can work out something from the flows through the Shanghai exchange, because all gold, as you said, all gold, domestic gold has to be bought through there, and all imported gold has to go through the exchange. So there is. We can get some figures that way. But yet, it was only last year, or what, 18 months ago, that the Chinese first announced what they were holding in gold. And that turned out to be a hell of a lot less than what people expected. So the Chinese will be the Chinese. Sorry, I don't really have a proper answer for you on that one. I can't stand up here and say that.
Yeah.
Yeah, hey, Paul. So years ago, you'd go to a function like this, and you'd hear Newmont get up, and they would show you their production growth profile looking forward 5 years. It would be a nice curve that was going up, and Barrick and Goldcorp would do the same. Now, if you go to that same presentation, everybody seems to be quite proud of how flat their production profile looks 5 years out. In the course of doing your analysis, you meet with all these companies frequently to find out what their 5-year forward projections are like. What are they telling you in terms of how they're going to resupply themselves, refill the pipeline in light of the declining exploration curves, declining discoveries, et cetera? I'm just curious.
Yeah, there's a number, George, thanks for the question. There's a number of points that, yes, we did see a lot of the big companies with very high, steep projections of where they're going. And of course, they didn't make it, most of them. So that's one reason value investors left our market, because management actually just weren't delivering, doing what they say. Firstly, I think they've changed. The last few years, as you know, there's been a lot of change in management. There's a lot of change. Shareholders have much more power now, and they've decided, look, we don't actually want this. We want let's run a profitable company and not the company with the largest reserves or the highest production in the world. You've seen how much Barrick is selling of non-core stuff because they've taken on so much debt, and then they're selling non-core assets to pay to refinance the balance sheet, basically. And they're looking at profitable ounces the whole time. They're looking at not just buying ounces for ounces' sake. They're looking at buying ounces that will actually that will be accretive, that lovely word that they use, that will make money for the business and the shareholder. They're looking at their businesses, their mines, rather than just rock factories. They're looking at them as proper businesses these days. And then the final point is, I think that's where the juniors will have played a role in the past and will have a great opportunity in the future, because with exploration down, if the juniors are out there being the pioneers, the vanguard of the industry out in some of these more risky areas, and if they're finding things like Eric was talking about Agnico holding a large share, and Agnico is one of the particular companies that's been doing a lot of that when the market's been in downturn. It's been buying stakes in a lot of the juniors and buying whole juniors at times, and they're going to continue to do that now. I think there's still good value out there for the majors. As to what their exploration policies are going forward, I don't know, but I think they're going to rely, certainly in the short term, on buying assets that are out there that are still undervalued from the juniors have developed to a certain stage.
Okay. More questions? Oh, yes, please, Malrad.
Oh.
Very surprising is, I think, the part of the cash investments or liquid investments of people have historically probably never been as low. Partial, the part in gold, invested in gold. I remember a friend of mine used in the last millennium to lead a private bank, and he said they always had 10% in every deposit in gold. And I mean, if it only would go up to 5%, gold prices would go crazy, really crazy. I mean, if 180 million people have 1 kilogram, all the gold is used up.
Well, again, that's.
So what do you think could be a trigger in the mindset of people that they have just more or less a fixed part of their cash holdings. I mean, any company, blue chip, whatever, can go bankrupt. We've seen it in Switzerland with Swissair, with major banks almost. And
I think if you look, maybe not. A lot of gold institutional investors will still look at, say, maybe. Well, it depends on the type of fund they have, but maybe 5% in equity, 5% in gold equities, 5% in bullion, and that's the sort of rule of thumb. But I think I think one of the key dynamics that we'll see going forward is the retail sector in the likes of China and India, because they're not only are their numbers going up, they're all becoming increasingly wealthy, and there are direct correlations between wealth and buying of gold, particularly in those regions where they have an affinity for the metal anyway. So I think that's going to be one of the major trends going forward. It's watch the East. Sorry, I don't think I answered your question, did I? Sorry.
I would say maybe if we get rid of COMEX, it works.
Well, yes. But except what will take its place is China.
Yeah.
China will be COMEX in 10 years' time. If I was standing here in 10 years' time, I reckon the Shanghai Gold Exchange will be in a much more powerful position than COMEX is now.
Yeah, definitely. More questions? Yes, please.
Paul, I got one question.
Patrick, yes.
You and I met a few times. We go to these conferences all over the United States and Canada. And one thing I've always noticed.
And we still can't remember a thing we said to each other.
Yeah, we usually have a beer or two and then we forget. But one thing I've noticed is what do demographics play? What roles demographics play in the demand for gold? Because whenever I go to these gold shows, I always notice I'm the youngest guy in the room, particularly in the United States. Do you think that has a big role in the demand for physical gold, for gold as an investment vehicle?
Yeah, that's to use your expression from earlier. That's a very good question. Yes, I think that our generation, well, at least my generation, has a relationship with gold. We remember when gold was still a pegged price in 1968. We remember when in 1971, 72, the gold market closed. Nixon closed the gold market. I remember in 75 when US individuals were allowed to own gold, and we saw quite a development then of the gold price going through to 1980. But yeah, the kids today, gold has to vie with the likes of iPads and other luxury items. They see it as a luxury item, not necessarily as a store of value. So gold will have to compete against those sort of things. And it'll happen in the East as well. But another huge demographic, a huge demographic is the population increases. As I just mentioned here, in China you've got an increasing middle class. The middle class now is bigger than in the US. And they are going to demand, they want gold. They want it as a sign of their wealth, and they want it as a store of value. The urbanization will lead to higher quality of life, and again, higher incomes and more demand for gold, I believe. So at the moment, China is about 55% urbanized. By 2040, the IMF thinks it'll be 70% urbanized. Western Europe, we're 80% urbanized. So there's going to be huge growth there. Probably the biggest growth is going to come in India. There you have something like, I can't remember the exact figures, but something like 60%, 70% of the population is under 21. Now, if they're increasing, it's a much more rural community there, but they're getting increasingly wealthy as well. And that'll be one of the keys for marketing organizations like the World Gold Council to say, no, don't buy this luxury handbag, but buy a piece of gold. Or don't buy a De Beers diamond, but buy a piece of gold. And that could be absolutely huge market, because the growth rate in India is far exceeding China. And in 15 years' time, India, if it gets its act together, gets everything right, will probably be the richest country in the world. So that's a huge opportunity, I believe, in that part of the world.
Pascal?
So let's assume I'm mad enough to sell gold, then I would try to achieve the best price, of course. But you showed the flash crash chart, where obviously nobody who would try to get the best price would dump billions in worth dollar terms of gold. So what's your best explanation for that? Maybe I should ask the BIS in Basel, but what's your best explanation for that? Who is in the position to dump such amount?
It's a speculator. Somebody.
Only one?
Well, sorry, I mean it's speculation on the market. I don't know who it was, but it was orchestrated and it was done with a purpose in mind to put the gold price down. Now, whether he had short contracts on the other side or his friend did, I don't know. But that's why that paper market is so volatile. Sorry? Yes. Oh, you're making faces at me. I thought. So yeah, it's a hugely speculative market, and when, 8 a.m. just about as trading opens, and you hit the market when it's quiet. It was 2013 when we saw a dump in the gold price. That was on a Sunday night, 8 o'clock in New York time, I think. Sorry?
Yeah,
the markets are thin.
Volumes usually, then
yeah,
the markets move the price.
Yeah, that's right. The markets were very thin at the time, and that's one reason we had one reason there was some selling a few weeks ago that had and there was no support because it was a Chinese holiday that week, and so the Chinese markets were closed and there was nobody to support the price. That's it, please.
More questions?
No.
Good. Perfect. Yeah, I think we made it. Thank you very much, Paul.
Thank you.
Thanks a lot. Ladies and gentlemen, thank you very much for your time and for your attention. I think it was a very nice evening. Thanks a lot. Thanks again to Andrew and Patrick to putting that together, and also thanks for our participating and sponsoring companies here, because without the companies this would not be possible, as you can imagine. And I think we got a lot of good information tonight, and I think very simple. If you don't want to be directly dependent of physical gold, quite simple, buy the shares of the companies who are here today. Much easier. And from that side, thank you very much, and I wish you a wonderful Christmas. Stay healthy, that's the most important thing in life, and I wish you a lot of time with your friends, your family, your partners, your whatever, so that you have the time to really sit together and enjoy the Christmas time, and maybe refresh a bit from those hectic things. In 1 week we have the US elections, maybe another hard day for us, we don't know. And the one or the other, it doesn't matter. And it's really not easy. So from that perspective, take care, stay healthy. Thanks a lot, and see you latest next year, same time, same occasion. Thank you very much. Bye-bye. Good night.